The artificial intelligence frenzy just hit a wall. A closely watched index of semiconductor stocks, the very backbone of the AI revolution, has officially plunged into a bear market. This isn't just a slight pullback. We're talking about a significant unwinding of a rally that saw these chip giants more than double in value in just 3 months. This structural shift demands immediate institutional attention. But that is only part of the story. Semiconductors are not just a hot sector, they are the bedrock of modern technology. From data centers powering AI models, to your smartphone, to advanced automotive systems, chips are indispensable. Companies like NVIDIA, leading in AI GPUs, and Taiwan Semiconductor Manufacturing Company, or TSM, the world's largest contract chipmaker, form the core infrastructure. Here's why this industry holds significant structural moats. It demands staggering capital expenditure, continuous R&D investment, and highly specialized intellectual property. Think of ASML, a Dutch company critical for lithography, or Intel, a foundational player with integrated manufacturing. These aren't easy businesses to enter or replicate, creating high barriers to entry and reinforcing their value proposition. Now look at how sector demand trends contributed to this recent volatility. The initial surge was fueled by an unprecedented demand for AI accelerators and high-bandwidth memory. Hyperscale cloud providers rushed to build out their AI infrastructure. This created a demand recovery that rapidly outstripped supply, pushing prices and valuations skyward across the entire segment. That explosive growth, however, masked underlying margin dynamics. The market's enthusiasm for top-line revenue growth in AI-related chips overlooked the cyclical nature of other segments, like memory. As the initial AI build-out matures, and with broader economic slowdowns, we're seeing a more normalized demand curve. This impacts sector-wide revenue metrics and potentially compresses margins if pricing power wanes. The next signal comes from the industry's capital allocation. Leading players like TSM and Intel continue to announce massive capital expenditure plans. They are investing billions into new fabs and advanced packaging technologies. This isn't merely chasing short-term demand, it's a strategic move to secure future market share and technological leadership, demonstrating conviction in long-term structural demand. This aggressive capital allocation highlights the strategic execution vector for the entire industry. It's about more than just manufacturing capacity. It involves diversifying supply chains geographically, strengthening R&D in areas like advanced materials, and ensuring energy efficiency. Industry players are positioning for a multipolar tech world, de-risking against future disruptions and geopolitical friction. That leads us to a bigger question regarding the macroeconomic environment and its impact. Persistent inflation and higher interest rates are tightening liquidity for both consumers and businesses. Add to that the intensifying US-China tech rivalry, which creates significant geopolitical friction over chip technology. These factors collectively create a difficult operating backdrop for even the most resilient chipmakers. Yet, despite these headwinds, structural tailwinds persist. The demand for AI computing is expanding beyond just the hyperscalers, moving into enterprise, automotive, and industrial IoT companies like Qualcomm, a leader in mobile and automotive chips, and Broadcom, with its networking and storage solutions, illustrate the diversification of demand. This broader adoption provides a longer runway for growth, even if the initial AI sprint slows. However, the inherent cyclicality of the semiconductor industry remains a critical risk. The recent 105% rally in just 3 months created significant overvaluation in many segments. History teaches us that such rapid price appreciation often leads to equally swift corrections as demand normalizes or oversupply issues emerge. Investors must differentiate between structural growth and cyclical peaks, especially for memory producers like Micron. Furthermore, regulatory and geopolitical risks are not diminishing. Export controls, government subsidies, and the ongoing push for regional self-sufficiency continue to fragment global supply chains. This creates potential inefficiencies and higher costs. Companies must navigate a complex geopolitical chessboard, impacting everything from R&D investment to market access and long-term strategic planning. Looking forward, earnings visibility is paramount. The initial AI rally was driven by speculation, not fully by realized earnings growth. Now, the market will reprice these assets based on actual revenue and margin expansion. This reassessment means looking for companies with diversified end markets and clear pathways to sustainable profitability, not just those with the loudest AI narrative. Expect more scrutiny on guidance. This leads us to the crucial multi-year investment thesis for semiconductors. The structural demand for higher computing power is undeniable. AI infrastructure build-out, the proliferation of IoT, and the digitalization of every industry will continue. The question isn't if, but how investors can gain exposure to this long-term trend while insulating against short-term cyclicality and market volatility. It requires a patient, selective approach. So, where do we stand from a tactical perspective? For specific segments of the market that may have benefited disproportionately from the AI hype, we suggest trim consideration as institutions rebalance their portfolios. Conversely, segments with robust secular growth drivers, strong balance sheets, and reasonable valuations, perhaps those that didn't experience the full froth of the rally, are moving onto our breakout watchlist. Look at the SOXX, the iShares Semiconductor ETF, for a broader sense of where capital rotation is occurring. The semiconductor market's recent tumble into a bear market is a critical repricing event, not necessarily an end to the structural growth story. Smart capital is now assessing true earnings visibility and sustainable demand recovery. The days of indiscriminate buying on AI narrative alone are likely over. It's a time for deep analysis, not speculation. For more institutional-grade insights like this, make sure you subscribe to SR Money News and hit that notification bell. We're here to help you navigate these complex market dynamics.